Hi guys, in this video I would be explaining about the P2P cycle and the basis of accounts payable. So P2P is called purchase to pay. It starts with purchasing a product and making a payment for it. There are many steps that are actually involved in P2P. So let us start with the first step. So P2P starts with materials requirement within the company. So for example, if I work in an organization and need any product or a service, I raise a requisition. So what is this requisition? Requisition is a document that contains details regarding the product, the quantity and the time frame. So it will notify the purchasing department regarding these three things, which is the product and the quantity and the time frame. So once when I send the requisition to the purchasing team will analyze the market and select the vendor. Here there are a lot of steps that are actually involved between the buyer and the vendor. It also depends upon the what kind of product that I've actually ordered or what kind of product that I've actually raised a requisition. For let's say, like, if any product, if any common product that I've actually ordered, so I don't think so buyer would actually analyze the market so much, but any product which is like which is in high value and a unique product, then the buyer will send a quotation to the vendors, and the vendors will send a quotation. And if buyer feels like one right vendor is suitable for this product, he will come in a close contact with him. He will discuss about the payment terms, the price, etc. So when everything between buyer and the vendor are settled, the buyer will issue a purchase order to the vendor. He will deliver the purchase order to the vendor, and when the vendor receives the purchase order, he will verify the PO and he will provide the goods to the buyer's warehouse. And in the warehouse there will be a procurement technician who will verify the goods with the purchase order, as well as the goods. He'll verify if both are same. He'll check if there are like any damages or else. And if once everything is fine, he will enter the goods receipt into the system. So here the journal entry will be inventory account debited to a GRIR account. Inventory is something which we are receiving and we are debiting the GRIR account. And vendor will send an invoice copy to the accounts payable team. Invoice copy actually contains details regarding the PO, invoice date, invoice number, the payment terms and everything. So once the account payable team receives the invoice copy, they post the invoice into the system. They will check the PO and the good receipt. If PO, good receipt and invoice match, then they'll post the invoice copy into the system. So here the journal entry will be GRIR account debited to vendor account. Being invoice is posted into the system, and based on the payment terms, let's say the buyer may say to the vendor like, I'll pay within 10 days, 20 days or 30 days. So once the invoice copy is paid to the vendor, the journal entry will be vendor account debited to bank account. These three journal entries are the most important journal entries in accounts payable. And there can be a case wherein we may return the goods to the vendor, like if there are any damage, if there are any damages in the goods, or let's say of any other reason, then the entry will be GRIR account data to inventory account. So this is actually vice versa to the of the good receipt. So this is what is all about the P2P cycle.